Hey, welcome back to the show. It's Sunday, the 6th of April. Great to have you with me. If you haven't subscribed already, please do. Like the video, tell your friends and family, click the bell for notifications. Appreciate it. Want to do a little economy check here, a review of last week, see what's coming up this week. A lot of consternation out there in the world. Donald Trump is being very disruptive to the system that's been in place for a long time, both on the fiscal side here in the United States and on the trade side, spooking the world, trying to correct serious imbalances we've suffered for a long time, namely our budget deficit and national debt, $37 trillion, and our massive trade imbalances since the 1970s, haven't run a surplus since 1976. 2024 trade balance minus 1.2 trillion. So these things are messy. The media is beside themselves across the board. How could he be doing this? There's pain to be had for sure. He's obviously trying to move quickly, knows he's a lame duck president. This idea is going to run for the third term. I don't think so. So anyway, very disruptive. So a lot of consternation, a lot of attention and eyes on the economy, markets. So let's check out on the economy. Checking back last week on economic data for the U.S. economy, we had the Chicago Purchasing Managers Index for the month of March, 47.6 versus 45.5 expected, which was about the same for February. First time in a while, we've seen an uptick in this number, still below 50, so a little contractionary, but a positive sign there. And what I want to quickly jump in on here is good data seems to be getting the right congratulatory of President Trump, bad data getting the left critical of President Trump. It's too soon yet. He doesn't own this economy yet. He's close, but he doesn't own the economy yet. We're still working off of the Biden economy, the Biden budget, the Biden cash flows. President Trump, and any president really, doesn't really get ownership or for credit or blame until 5-6 months in. So think June. Anyway, moving on. That was it we had from meaningful data on Monday, the 31st. Last Tuesday, the 1st of April, April Fool's Day, we had construction spending for the month of February up 0.7%. Well better than expected, well better than the prior month. Not a bad sign. A volatile series, construction spending, but a good number there. Indicative of what we've known for some time. We're in a slow growth economy, potentially moving toward recession. I would say recession is long overdue. We've only been buoyed by large-scale immigration and massive deficit spending by the local, state, and federal governments. It's really all the meaningful data we had out for last Tuesday, April 1st. As always, on Wednesday, we get the MBA mortgage applications for the week ending the 28th of April, down 1.6%. On the back of it, down 2% in the prior week. 30-year mortgage rate at 6.7%. Home prices still near all-time highs. Then on Wednesday, the first look at jobs from March, we had the ADP non-farm employment report. This is the private check writing company. Does not include government employment. 155,000 net job growth for the month of March. Well better than expected. Well better than the month of February. Not a great number, but a good number. Again, a low growth economy. A lot of part-time jobs. A lot of jobs going to foreign nationals, which we'll see when we talk about the Friday data. Also on Wednesday, the 2nd, we had factory orders for the month of February. Good number, 0.6% better than expected. Not quite as high as the prior month. This is a number we'll look to see if President Trump's effort at reshoring manufacturing takes hold over the next 18 months or so. On Thursday, as always on Thursday, initial unemployment claims for the week ending the 28th, 219,000. A little better than expected, better than the prior week. This number has become meaningless. Something's fugazi in this number. It hasn't nudged in years. It's been stuck in a very narrow range for a long time now. Something's not right here, but nonetheless, it's sending a signal of a strong labor market. Even though we look in the details, and again, we'll mention this in just a sec, the labor market's not as strong as the numbers suggest, but these numbers suggest a good labor market. These low unemployment claims numbers indicate that very little layoffs are occurring, yet we have evidence in the headlines to suggest otherwise. So a bit peculiar there, a little disconnect. Then on Friday the 4th, last Friday, as always, the first Friday of the month, it's not literally the first day of the month, we get the employment situation report from the Bureau of Labor Statistics, non-farm payrolls, average hourly earnings, average weekly hours, the U6 unemployment rate, the broadest measure of unemployment we have, and the U3 measure, which is the most public and the rate used by the media. Non-farm payroll job growth, 228,000, well above expectations, well above the month of February. Good number, in line with the ADP number, again, indicating a low growth, 2.5% GDP economy. Not too bad for a mature economy such as ours. Again, when you look at the details of this, you go to the BLS.gov and look at this subcomponent tables, you'll find still most of the jobs we're creating are part-time jobs, and most of the jobs are going to foreign nationals. So we look at the details to find some weakness. The number of Americans with multiple part-time jobs remains their all-time highs. So a good number on the surface. The Fed seems to think the labor market is pretty tight. Average hourly earnings of 0.3% for the month. Not bad for workers, not so good for employers, although year over year still a little bit elevated, 3.8%. That'll keep the Fed spooked a little bit. Fed's on hold, I think, barring further financial calamity. We'll talk about this in a second. Average weekly hours, 34.2 hours per week. Hasn't changed in a long time. U6 unemployment rate, 7.9%, the broadest measure. And the unemployment rate, U3, 4.2%. Both a little bit higher than expected and a little bit higher than the prior month. Remember, I think our best measure to look at unemployment is U6. It's the broadest measure, ticking up a bit, 7.9%. This number includes discouraged workers, those that have given up looking for work, even though they're willing and able to work if it came their way. All right, so for the week, not a whole lot there to change the Fed outlook. At their last meeting in March, the Fed said they're going to cut a couple times in 2025, bring us down to 4%-ish for the federal funds rate. The market turmoil we're seeing right now has been an indicator of Fed intervention to support banks and hedge funds by lowering interest rates. Hopefully, they won't do something silly and go ZIRP again, zero interest rate policy. The market is obviously very volatile given Trump's efforts with tariffs and rebalancing our trade situation. So the data that we see this week, we saw the trade balance. I forgot to mention it actually from Thursday. The goods and services trade balance for February, minus 122.7 billion. A near record number on a monthly basis for goods and services. Again, importers trying to get ahead of Trump tariffs. So not much in the data this week to change the Fed outlook. I still like to see the Fed stay on hold or at least just go one more rate cut for the year of 2025. I think we still have inflationary pressures out there that need to be managed. And of course, we need to prick the bubble that is equities. Now, listen, I'm a 401k guy. I know my friends and families are 401k people with pensions, of course. This is painful what we're going through right now. I just want to remind you some broader perspective that the S&P and the Dow and almost straight up for 15 years with some periodic sell-offs lasting, a few days to a week tops, with the Fed coming in and cutting interest rates and injecting new money into the system. So we need to pop this bubble that is equities. No denying that. Painful to watch this. Remember these massive moves we're seeing this week on the back of the Trump tariff headlines. These are not driven by human beings. So these unusual drops, these large gap down, 1,000-point moves in the Dow, 100-point moves in the S&P. These are driven by algorithms. One algorithm chasing after another, taking out stops below and below and below, sell stops for people that are long. And then, of course, people trying to get short. So these moves are overdone, to be sure. The term we often hear about this is called overshooting to the downside. So this might be a sell the rally market for another couple of days. Then it's going to be a buy the dip market soon. And we'll see what the Fed does. Keep an eye on Fed headlines for possibilities of emergency meetings or rate cuts. All right, now checking into this week here, week of April 7th. See what's coming up for us. Usually the week after the employment situation report is a very quiet week for economic data. Now, I want to remind you again, I track about 34 to 36 data points on a monthly basis that I've identified over years of trading and analyzing the economy that move markets. There's lots of other data out, and if you want to check that out yourself, there's lots of economic calendars you can find online. So we're just doing 34, 36 of the market-moving data points. Anyway, with that in mind, nothing on Monday, April 7th. Again, Tuesday, April 8th, no data. As always, Wednesday, April 9th, 7 a.m., MBA mortgage applications for the week ending April 5th. We have the FOMC minutes Wednesday afternoon at 4 p.m. If you want something to help you go to sleep, that's a good thing to read. FOMC meeting minutes, you can find it at federalreserve.gov. Thursday, the 10th, as always, initial jobless claims at 8:30. Looking for something in the low 200s. Also, our first look at March inflation with the March Consumer Price Index, the CPI out for the month of March, looking for up 0.1%. And also on Thursday at 4 o'clock, we get the federal budget balance for March, looking for approximately a deficit of 125 billion. I think we'll go a little worse than that. Spending seems to be a little out of control in the month of March under the Trump administration. So much for balancing budgets and reducing debt. Friday the 11th, we have another look at inflation with the March Producer Price Index, the PPI, looking for up 0.2%. This is where we'll see some pressure on tariffs initially. And also at 10 o'clock on Friday, our first look at April Michigan consumer sentiment, looking for 54. Numbers been a little bit elevated but quite bifurcated by Democrats and Republicans, with Democrats very down on the economy, Republicans more positive about the economy. So not a lot to look at this coming week. Keep an eye on headlines for everything related to tariffs, any surprise meetings or conversations by the Fed. Watch for a possible Fed rate cut. All right, that's all I have for you right now. Always try to buy American.